As a financial advisor, I see a lot of mistakes. And one of the most common and big ones I see is ignoring taxes while you invest. This mistake could cost you a lot of money. So in this video, I'm going to walk you through the basics of investments and taxes, how different types of investments are taxed, and how to reduce your taxes while you invest. An important disclaimer: I am a CFP professional, but I am not your CFP professional. So nothing I state here is specific advice for you. You should always consult with a professional before implementing anything you read or you watch online. That being said, let's get into tax efficient investing. To start, you need to understand how your investments are taxed. Tax on investment falls into two big categories. One category is ordinary income tax, and the other one is capital gains tax. Ordinary income tax is the tax that you pay on your employment income. So your salary, your tips, commissions is all taxed this way. And this is the type of tax that most of us are familiar with. But we also have ordinary income tax in investing. So for example, the interest that the bonds pay you or the interest from a high yield savings account, that is also taxed as ordinary income. And we're going to talk more about that later because we will talk about how to minimize the ordinary income tax in investing. This is the 2024 ordinary income tax table. It might look familiar to you. When people say something like, I'm in the 22% bracket, or that problem is beyond my tax bracket, this is the type of tax they're referring to. But there is a second way investments are taxed, and that is capital gains tax. In investing, things like qualified dividends and gains from selling your investments are taxed this way. So for example, let's say you bought an S&P 500 fund for $100. You bought it 7 years ago, and now today you decide to sell it for $200. Well, simple math, but that is a $100 gain. That gain is taxed as a capital gain. These are the capital gains rates. And what you'll notice is that capital gains tax rates are lower than ordinary income tax rates. So if you had to choose, do you want ordinary or you want capital gains tax? You would always pick capital gains tax. And this is how the wealthy minimize their taxes. While many of us are paying ordinary income tax on our income from employment, the wealthy have most of their money in investments where they face capital gains tax. But there is one condition here. It has to be a long-term capital gain. So when you go to sell your stock or your fund or any investment and it has a gain, that gain is either going to be classified as a short-term capital gain or a long-term capital gain. And it's a short-term capital gain if you sell an investment you held for 1 year or less. It is a long-term capital gain if you sell an investment you've held for over 1 year. So that example earlier with the S&P 500 fund, we said you bought it 7 years ago. That's easy. That's a very long-term capital gain. Now, why do we want it to be long-term? What's wrong with the short-term capital gain? Short-term capital gains are taxed as ordinary income, the higher rate. This is why a powerful investing strategy is to hold investments for the long term. Not only because you have a better chance for higher returns when we zoom out and we look at it on a long-term time horizon, but also because you get that better tax rate. It's truly a win-win. All right, now that we have the basics and we have this knowledge covered, it's time to apply it to your investments and start saving on taxes. We are going to walk through 6 common types of investments and talk about how you should set them up to avoid taxes eating into your returns. First, we are going to tackle active and passive funds. I see this mistake all the time and it is so avoidable. An active fund is when you buy a mutual fund or ETF that is actively managed. And what that means is the fund manager is doing a lot of trading. So they might be buying and selling stocks daily. which means they are definitely not holding those securities for the long term. As a result, active funds create more short-term capital gains. Now, passive funds, on the other hand, which are often referred to as index funds, they don't trade as much. So it's more likely that the fund manager is holding the investments for the long term. Passive funds are how they sound. They're passive. The fund manager is not doing a lot of active trading. As a result, we're going to label active funds as tax inefficient and passive or index funds as tax efficient. This matters for where you place these investments, which I tackle at the end of this video. Next, we are going to talk about stocks versus bonds, or stocks versus bond funds. Most stocks pay something called qualified dividends, if they do pay dividends at all. There's plenty of companies that choose to reinvest their cash instead of paying dividends. But remember here, qualified dividends are taxed at the preferential capital gains rate. So while bonds pay interest, which I covered earlier, and that interest is taxed as ordinary income, stocks typically pay qualified dividends, again, if they pay anything at all. So we label stock funds as tax efficient and bonds or bond funds as tax inefficient. Can already tell, I am obsessed with taxes, and it's because taxes have a huge impact on your financial life. If you have a goal of becoming work optional, like me, hit subscribe below so you never miss a future video. Rounding out the investment portion, we are going to cover REITs and municipal bonds, or munis, sometimes they're referred to for short. REITs are real estate investment trusts. It's an investment in real estate that you can access through the stock market. Now, REITs typically pay non-qualified dividends, and non-qualified dividends are taxed as ordinary income. Municipal bonds, on the other hand, are bonds that are issued by state and local governments, and they actually have a perk compared to regular bonds. Municipal bond interest is free from federal tax and sometimes state tax if you purchase the bond within your home state. So REITs we label as tax inefficient, while municipal bonds are tax efficient. Now let's move on to the very important part of placing the investments, because none of this matters if we don't take this knowledge and then apply it to our investment strategy. To start, let's assume you have 3 accounts. These are going to be 3 common accounts, and they are all taxed different ways. So let's assume you have an individual brokerage account. This is a taxable account. It's taxed as you go. Let's also assume you have a traditional 401k. This is tax deferred. Money goes into this account pre-tax. And finally, we're going to assume you also have a Roth IRA, which does not go in tax-free, but does grow tax-free. Starting with the individual brokerage, like I said, this account is taxed as you go. It's sometimes called a taxable account. As dividends are paid out in this account, they are taxed in that year that they pay out. And as interest is paid out, it is also taxed. Because of this, we want to do our best to choose tax-efficient investments for this account and try to avoid ordinary income tax. So let's think about what would be a tax-efficient investment we can place into this account. Index funds. Index funds do little trading and typically pay qualified dividends, so they would be great in this account. If your asset allocation at this point in your life includes bonds, then municipal bonds would be great for this account. What we're doing here is we're taking tax-efficient investments and a tax inefficient account and pairing them together. Next, we have the traditional 401k. This account grows tax deferred, so we actually completely avoid taxes while it grows. So this is actually a great account to place tax inefficient investments. This is things like bonds that pay interest or REITs that pay non-qualified dividends, and active funds if you have them. I like index funds. Finally, for your last account, we have the Roth IRA. This account grows tax-free. So just like the 401k, we can place tax inefficient investments here. But remember, unlike the 401k, you don't pay taxes when the money comes out of a Roth IRA. That's why we say the 401k grows tax deferred, while the Roth IRA grows completely tax-free. Because of that, we can place investments here that we think will have larger gains. like stocks compared to minimal gains like bonds. So to summarize, we have tax efficient investments in the tax inefficient account, the brokerage account. We have tax inefficient investments in the tax efficient account, the 401k. And finally, with the Roth, we take advantage of tax-free growth and we place our investments with the most growth potential here. Now, one very important note that I have to mention, asset allocation is way more important than asset placement. What do I mean by this? If you are decades away from financial freedom, you very well may have a 100% stock portfolio and maybe it's entirely in index funds. You don't have any bonds or other types of investments to place. It's more important to stick to your asset allocation that's appropriate for you and for your goals. That's a wrap on tax efficient investing. Thanks so much for watching this video.